Let's get more on that speech now with Stephen Nash joining us from FIIG Securities. And Stephen, we just heard the Treasurer there explaining why the government aren't just letting these automatic stabilisers work their magic and why they're pushing for a surplus. Now, we know there are political pressures at play, despite what some people are suggesting. Yeah. But do you think that that's a valid query?
Look, I think it's very important for the Australian government to maintain fiscal discipline at this time, mainly because of the implications it may have for the Australian government rating and the sale of ongoing sale of bonds and interest rates in Australia. So any loosening of fiscal discipline will feed through into perceptions of risk, and that may increase borrowing costs. Overnight we saw a contraction in the Australian-US 10-year spread, as people anticipated that this fiscal tightening may lead into extra pressure on the RBA to possibly consider easing policy.
And just combing through the speech, we heard talk of an oil price shock. We heard more talk about cuts to government programs. Yeah. Is there anything in that, or even any of the rhetoric surrounding the dollar, that surprised you at all?
Look, I think it was a detailed commentary on the receipts that the government is getting and the extent of how much they have to revise down those receipts. So I think that's the thing that Swan's trying to get across, that receipts aren't as high as they would have liked, and that there'll have to be cuts as a result of that. Given that we're coming out of the financial crisis, I suppose that those cuts are required, particularly when you consider what's happened to other governments who have been fiscally a little bit slack, for example in Spain and Greece.
Is there any chance, or there is a chance, but borrowers are wondering, will this fiscal tightening push the RBA towards further easing?
Well, just looking at the context at the moment, we've had a series of weaker than expected releases. We have an anticipated fiscal tightening now. I think that's been confirmed. And basically there's a setup, I suppose, for arguments pointing towards an easing. That seems to have come straight back onto the agenda of late in terms of financial market pricing. So bond markets are starting to build that in. Is there a case right now for it? Probably not, but I think the case is building.
And Stephen, I also want to get your take on the RBA financial stability report that we saw released yesterday. Yeah. We've seen some warnings by rating agencies, Fitch I think, but this latest report seemed to allay some of those fears.
Yeah, there has been some commentary by Fitch about delinquency increases. The Fitch data covers what they call securitized loans, whereas the RBA data is broader, and it basically allays some of those concerns. I think we've had a series of those. Bank of Queensland have made some comments as well as Stockland, and the Stockland comments focus particularly on the recent independent rise by the major banks and the effect that's had on the property market. So although the RBA numbers do allay some of those concerns, I think people should consider what's going on in the property market in a little bit more detail, particularly with regard to RMBS securities.
And just finally, Stephen, US Fed Chairman Ben Bernanke speaking yesterday in a television interview, and he seemed to be trying to hose down some of the optimism we've been seeing in the States. The oil price is soaring, equities have posted incredible gains for that first quarter, that volatility index is very low, but economic growth still around 2%. Do you think he's trying to sort of shake people up and say, have a closer look?
Well, it's not just one interview. However, it's unusual for the chairman to go on TV, but there's been a series of statements by Fed officials indicating that they need extra growth, that current growth is not adequate to reduce unemployment. I think it's really trying to emphasise to the market that growth is good, it's better than expected, but there's a lot more that needs to be done. So getting too optimistic about growth is probably not the way to go. Also, we've had in the last few weeks a sell-off in the US bond market, and I think that is of particular concern to the Fed, and recent statements have allayed a lot of those concerns, I think.
Stephen Nash from FIIG Securities, thanks for your time this morning.
Thanks very much.